you're doing great today. In prior videos and blogs, we discussed the importance of risk management and covered some of the key risks typical for commercial real estate, as well as strategies we've taken to mitigate some of those. However, the principle of risk management also applies to managing one's own individual portfolio. And in today's quick snippet, we'll discuss just that. But before we begin, just a reminder that our videos are for educational and entertainment purposes only and do not constitute tax, legal, or investment advice. So let's begin. We're namely referring to the concept of portfolio diversification. Now, we've mentioned before that when you start investing, it's important to be focused and select one asset class, one strategy, one market, one sponsor. It definitely helps you get to know that market, that sponsor, better understand how to analyze the underlying investment and remove that initial feeling of overwhelm. But over time, as you gain experience, as you gain comfort level, as you start accumulating investments, diversification helps spread the risk across your portfolio. And there are a number of ways you can achieve that diversification. One is diversifying across sponsors, the sponsors that you met at various meetups, conferences, or perhaps a sponsor that a fellow passive investor referred you to. Number two, diversify across markets. For example, currently markets like Florida and Texas are experiencing exorbitant increases in insurance, which are inevitably resulting in cash flow compression. One way to manage the overall cash flow performance within your portfolio is spread across other markets that are perhaps not as severely impacted. Number three is diversify across various asset classes. We specialize in the multifamily space, but there are a ton of other asset classes that we've discussed in prior blogs, such as self-storage, industrial, retail, hotels, and so forth. Number four is asset subclass. We specialize in the Class B and C plus space. We don't do deals in the Class D space, but if you're looking for a safer investment with perhaps in exchange for a lower return, so something more stable, you may be more interested in a turnkey or Class A property. Again, do your diligence on the market and submarket, because currently certain submarkets are a little bit more impacted with a ton of new supply coming on board, which is affecting the Class A market as well. So do your homework, but that's subclass is another way to achieve diversification. And number five, last but not least, is investing in a fund where the sponsor will curate different investment opportunities and thereby achieve a certain level of diversification, so you don't have to do that heavy lifting. Ultimately, select an approach that's most closely aligned with your risk appetite, investment goals, and objectives. But these are a few strategies that you can deploy to achieve diversification within your own investment portfolio. We hope you found today's video helpful, and if you did, please like, share, and subscribe, and we'll see you at the next one.